Are you 100% confident in your retirement plan? Do you think that you've properly planned for the major risks that could derail your retirement? So, today we'll be discussing risk to your retirement. Specifically, we'll focus on 7 risks to your retirement that we believe have the biggest impact to your success and comfortability once you enter those glory years. So, I was doing a client meeting recently, and the client is planning on retiring here in the coming months. And she said to me, "Well, once you retire, aren't you just planning and looking forward to your death?" And I said, "No, far from it. I really think these are the years where you can try new things and really have freedom with your time to do whatever it is that you want. And if you enter this retirement chapter truly in control of your finances, you can do whatever it is that your heart desires." So, quick disclosure, the information that's discussed in this webinar today should not be taken as tax, legal, or investment advice. So, please consult the appropriate professionals with regards to each of those items. I'm Brandon Clark. I'm one of the certified financial planners here and also head of business development at the Clark Group Asset Management. And you may see me more often on the webinars that we do, some of the social media campaigns that we do, given that business development role. But by working with the Clark Group, you really have everyone here that you can see on this page. You've got the full team really at your disposal. We are a full fiduciary wealth management team, also known as a registered investment advisor. And what that means is we're always putting our clients' best interests first. Now, we're located in Southern California, but we have clients all over the country. Now, one thing that we do that I don't believe a lot of other firms out there do is more comprehensive financial planning. And we do take pride in being much more in depth with our planning process than those traditional advisory firms. Instead of just focusing solely on your portfolio, we focus on other facets of your financial situation. So we'll look at tax planning, estate and legacy planning, risk management, and then, of course, portfolio management, where we do think that we shine the most in. Now, on this chart here, I do believe that all the elements that you see on the left-hand side are crucial to long-term financial success. In other words, they're really going to truly help you maximize your wealth. However, one that really stands out to me is getting to know your why, figuring out what really makes you happy in life, and then creating that dynamic plan. I say the word dynamic because it's not just a one and done. It's always going to be changing based on your situation, certain life events that happen to you and to your family. And we see retirees all the time kind of lose their sense of purpose in retirement. They go from being, let's say, a busy executive, an engineer at an aerospace company, a small business owner, which is really part of their identity, to then retiring and being labeled maybe just another retiree. So, helping with this transition when entering retirement and really helping you define that why or what's important to you is something that we don't take lightly. So, retirement, the moment that most of you have all been waiting for, maybe not everyone, but I figure most of you listening in are looking forward to retirement. But according to the National Vital Statistics Report, 1 out of every 2 people will live 22 years or more in retirement, and 1 in every 5 will live 32 years or more in retirement. 32 years. Just think about how long that is for a moment. Consider all that you've done over the past 32 years. You've probably built a career, you may have raised a family, you may have gotten a divorce, may have raised grandchildren or helped with that process. Maybe you've traveled the world. Now, think of all that's happened in the world itself. Since the late 1980s, our country has been led by 8 different presidents. We, of course, have a presidential election coming up soon here, so potentially ninth or still one of the same. You watch the Soviet Union fall. You saw the terrorist attacks of 9/11, the reemergence of China, and most recently, the impacts of artificial intelligence. And then, of course, a little tool called ChatGPT that is AI related. 32 years ago, your phone was in your home, and today you probably carry it around everywhere with you. I know I do, which is kind of a bad habit. Not to mention, your car probably talks to you. Sure, it's got a GPS, might even be fully electric. So now that you kind of have an idea of how long 32 years is, ask yourself what you should be doing today to prepare for the possibility that you'll be retired for that length of time or potentially even longer. Of course, how we define retirement, it's changing. It probably will continue to change over time. It no longer means just watching TV all day, finding a comfortable spot on the porch, maybe doing a couple hobbies. Today's retirees are looking for that second life. They're starting businesses, they're pursuing new careers, they're spending time volunteering at their favorite charities or causes. So, to my previous point, understanding your why, it's really important because hopefully you do live approximately 32 years, and hopefully those years are healthy where you have a true purpose along the way in retirement. So, risk number one, running out of money. It's brutal, right? Just the thought of that risk alone makes me pretty nervous. And it might seem like an obvious one to plan for, but you would be surprised at how many people end up running out of money in retirement. According to Business Insider, roughly 45% of retirees run out of money in retirement, even if they diversified their assets prudently. Now, I figure those of you, just like our clients, are probably going to be in the 55% or will be in the 55% category. And I'll talk about some of the risks we see there. But the other six risks we're going to discuss today consequently cause risk number one to take place unless the proper planning occurs ahead of time. And not just, let's say, few weeks before retirement, well ahead of retirement, typically about 3 to 5 years. And then, of course, that continuation throughout retirement. Now, another risk that's less commonly discussed, and I think this is important for those listening in, and it is pretty important for a lot of our clients, is actually outliving your money and never getting to really enjoy your wealth. A lot of our clients are diligent savers and investors, and I do think that that might apply for you listening in as well. And I'll give you an example. So we had a client years ago that had a significant net worth. They were considered an ultra high net worth individual. Their assets were above $15 million. And they never wanted to spend or enjoy their wealth while they were working. This client was a top executive at a company, and they spent their entire life being frugal, saving, and really investing in the right way. They were wired to save, 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 and to switch that mindset to the distribution phase in retirement was really tricky for them to do. When they finally retired after that successful career, we really encouraged them to spend their wealth. They were planning on donating a majority of their assets to charity. They didn't have any children that they wanted to leave assets behind to. So again, we wanted them to enjoy their wealth as much as possible. And the client did say to me, one of the goals that I do have in retirement is to travel. I want to travel as much as I can, see the world, because I didn't do that when I was working. Well, unfortunately, they ended up passing away only 3 years into retirement, and they only took one trip internationally. We call this a risk for retirement as well. So it's something that you want to plan for. However, for today's discussion, we'll focus on running out of money because I think that's a bigger concern. Whether it be a bigger risk, I think it's a bigger concern for those of you listening in. Now, what creates the risk of running out of money is typically incorrect asset allocation for your retirement assets leading up to, and then of course, during retirement when those distributions finally begin. We'll talk about sequence of returns risk because that's a very important factor to look at when you're planning for retirement. But generally speaking, how can we limit the risk of running out of money? Within retirement planning, there's a rule, it's a common strategy, common rule of thumb called the 4% rule. There's actually been a lot of debate within the planning industry as to whether this withdrawal rule of thumb is still effective. A gentleman by the name of William Bengen. He's a retired financial advisor, but he created this rule back in the 90s. And he had stated that the 4% guideline really was intended as a worst case scenario. And it was intended as a worst case scenario for retirees, specifically in the US, where if you had retired in 1968, right before a pretty long, dragged out bear market occurred, and then in turn, high inflation occurred in the 70s, how would you have performed? Well, in that scenario, a 4% withdrawal rate allowed the investors' funds to last roughly 30 years. Some research shows that even a 5% distribution is considered safe and 4% may be antiquated. Without spending too much time on what we think is right, what we can say is that the 4% withdrawal is a conservative measure that we have the utmost confidence in that will help you keep your assets throughout retirement. So as long as your asset allocation is appropriately allocated to meet your specific risk tolerance and emotional moves don't happen in retirement, kind of gave away one risk right there, but the 4% rule has proven to consistently work. So how does it work and why is it effective? So if you're able to generate, let's say roughly 5% as a return and you're only taking out 4%, you can actually see your assets incrementally grow over time. So let's take a look here at this chart. You can see a $500,000 starting value in the first year of retirement, and easy math, you multiply that by 4%. And in dollar terms, that's $20,000. Now, instead of just taking that $20,000 and doing that again as a distribution in the second year, you adjust that for inflation, call it 2.5% as a cost of living adjustment for inflation. So that comes out to $20,500 in the second year. Then again, you do the same thing. You adjust that number by 2.5% and so on and so forth. And that's essentially how the 4% rule or 4% withdrawal strategy works. Here's another visual of the 4% rule. And as this chart shows, on average, a 4% initial withdrawal rate results in the retiree finishing with nearly triple the original principal, on top of sustaining an initial withdrawal rate of 4% adjusted for inflation, similar to what we had just shown. And in fact, only 10% of the scenarios does the retiree even finish with less than that 100% starting amount. Doesn't mean zero, just means little less than that amount originally. Now, another important factor is, where do you pull these funds from? Do you pull it from a taxable brokerage account, a traditional IRA or 401k, a Roth IRA? And pulling out these funds tax efficiently makes a very big impact, because if you're paying taxes and you're doing it inefficiently from your portfolio, that in turn creates more money out of your nest egg that you're depleting. So we want to make sure that we're doing it in the most tax efficient way as well. Now let's take a look at risk number 2, which can be the biggest impact to running out of money. So similar to risk number 1, experiencing a market drop in the early years of retirement can create problems that go well beyond the immediate hit to your portfolio, and potentially to the point where your portfolio may not last as long as you need. That could prove catastrophic if you're just embarking on retirement, or what could turn out to be, like we discussed earlier, a potentially 25 to 30 plus year retirement. So the timing of returns, the timing of a potential bear market really does matter. So at issue here is a phenomenon called sequence of returns risk. This is a really important topic within financial and retirement planning more specifically. So the word sequence refers to the fact that the order and timing of poor investment returns can have a big impact on how long your retirement savings last. After all, a portfolio generally isn't specifically a retirement portfolio. It's not just a lump sum of cash that you have earning, call it, or in CDs or cash earning you a very conservative rate of return, nor should it be. It usually includes and should include a mix of investments that can provide both income and growth over time. Ideally, the growth will replenish at least a portion of what you take out. So similar to what we talked about with earning, let's say, a conservative 5% return over the course of retirement, but you're only taking out 4% adjusted for inflation. That is a great strategy to use in our eyes. So if we do experience a major drop in the early years of retirement, this can, of course, scramble the probability of success for your retirement accounts. So when you tap into your portfolio as it's losing value and you have to sell more investments to raise that cash for those distributions, not only does that drain your savings more quickly, but it also leaves fewer assets that can generate growth and returns during those eventual recoveries. So essentially, you're compounding losses if you have to sell during a bear market, especially if you have to do so at the beginning of your retirement. So this chart here shows the difference in retiring with the timing of a bear market really not working in your favor. What we see here are two investors. We got investor number one and investor number two, and they both start out with $1 million. And they're both taking out 5% adjusted for inflation, about 2% in this example here. But investor number one experiences a 15% drop in their portfolio value right as they retire. Investor number two experiences that about 10 years out, so significantly later on in retirement. Investor number one, who faces that decline earlier on, runs out of money significantly sooner than the other investor. Actually, about a $400,000 difference over the same, call it roughly 20 years in time. And that's why mitigating the risk of sequence of returns is essential within retirement planning. So one question we often hear from potential clients that are gearing up for retirement is, well, Brandon, I've got a target date fund, so I'm all set, right? And a target date fund will most likely not help you get to your goals. Target date funds are what we like to call very cookie cutter, and they don't take into consideration your entire financial picture. We also often see new potential clients that have a significant amount saved up. So maybe they have 4 or 5, call it maybe $10 million saved up for retirement. So right off the bat, we know they'll most likely be comfortable with withdrawals as long as their expenses aren't too high. So they think, well, I don't really need to worry too much about market fluctuations. That's not necessarily true either. And then finally, one other concern we often see with potential clients are that they have their retirement accounts allocated as if they're still in their 30s, 40s, potentially even early 50s, and they're still in that wealth accumulation mindset. There comes a point where having 100% in equities might not make sense for you based on your retirement goals, based on your risk comfortability, and then, of course, your distribution needs. If you're one of the few where you can emotionally tolerate full declines of the equity markets for, in turn, the premium returns that they provide, more often than not, people can't, then you could be okay with seeing those market declines. It'll just come back to what your distribution needs look like from the portfolio. But psychologically, can you tolerate those declines if you are taking out a certain amount of money? And then, of course, the element of sequence of returns risk comes into play. Probably not. And we do believe it's not a matter of if a 50% decline happens. I know that sounds bleak. It's really a matter of when. That's just the reality of investing. We've seen it multiple times and will most likely experience it again. So you do have to plan for those worst case scenarios. So more specifically, how do you plan for sequence of returns risk? It all comes back to your goals and your distributions. As cliche as that sounds. After you hone in on what those goals are, you want to build out a dynamic plan for your own unique situation that balances, let's say, both growth and income. We've also seen potential clients that come to us and say, well, I have a coworker or a family member and they're doing it this way. Can I just do it that way? It doesn't work like that. Well, first of all, you probably shouldn't be taking advice from family members on your investment assets, but secondly, their situation is very different than your situation. Everyone's situation is unique. Now, one thing that we do advise clients on when they're gearing up for retirement, this probably is one of those things that make people cringe, but it's creating a budget and really tracking what your expenses are. If you have an accurate idea of how much your expenses are, we can then work backwards to build out your plan and see how much cash flow you need to live off of from your portfolio. By taking the time, by really taking the time, it's not something that you do lightly. You really want to spend a lot of time on this. You can potentially limit excessive withdrawals and help withstand severe bear markets when they do eventually occur. And in turn, you can help avoid sequence of returns risk impacting your portfolio. So we just talked about planning ahead for the right asset allocation for you based on your goals. Let's move over to some of the emotions that come into play. So risk number 3 is the emotional moves with the market and your portfolio. Many people after the financial crisis in 2009 would say things like stocks are too risky. So what they did was they stayed out of the market. They said, "Oh, I'll just wait until the market recovers." Then you would hear probably the same people say things like, well, now stocks are too expensive after we just had a massive bull market for many years. I'll wait again until the markets cool off a bit and then buy back in. Also a big mistake. So historically speaking, if you look at main asset classes within a retirement portfolio, you can have other things like real estate, investment trusts, gold, potentially digital assets. But if you just look at the main assets within a retirement portfolio, equities, bonds, and cash, historically speaking, equities provide an average annual return of about 10%. Bonds are at roughly 5%, and cash is at roughly 3%. As you can tell, too much or too little in each asset class can impact your long-term performance. We mentioned seeing clients taking on too much risk. They have that wealth accumulation mindset, say they're 100% in equities. But what about the opposite of that? Taking on too little risk for your portfolio based on your goals. So the average intra-year decline in the equity markets, the average is roughly 14%. But in turn, as long as you have that long-term perspective, you can potentially generate north of 10% returns like we had just discussed. Now, of course, that's looking back historically. Past performance, as I'm sure you know, is no guarantee of future results, but it does give us some insight as to what we could expect moving forward. Over the years, we've seen people that are gearing up for retirement allocate way too much of their portfolio in cash or in bonds, usually based on emotions, and it's not really a methodical process. Similar to what I just explained, they've had a bad scenario, they got hurt, they maybe didn't have the right guidance, and they're allocating their portfolio based on emotions. What we want to do to avoid being emotional in the market is planning ahead for those really nasty periods in the market. Some of you may be thinking, well, what about getting in and out of the market, going all in or all out? Timing the market seems pretty simple in theory, but when prices are low and you sell, it's not really the best strategy long term, or at least near the bottom. And now, of course, you can't predict when that bottom takes place. Some people also say to us, well, can't you just buy when prices are low and sell when they're high? You can't consistently do that. And what we think typical market timing looks like is trying to predict what can happen next. So, for example, we have the presidential election coming up. There are some, let's say, financial wizards out there that think, oh, we can try to play the election and time the market in the right way. We'll do some shifts to the portfolio right now. But trying to consistently do that over time is not advisable. And there's very clear evidence that trying to do this is extremely difficult. So if you look at this chart here, you can see the benefits of having that long-term perspective and staying invested. If you missed out on just the best 60 days, if you started with, take a step back, if you started with $10,000 invested in the S&P 500, January 2003 to the end of 2022, which we had a pretty ugly bear market then, your value would be even less than what you started with at $4,200. But if you stayed invested, you stayed disciplined, you'd have about $64,000. Pretty big difference. It's about a 60% or almost 60% as a loss here in this scenario if you miss those best days. So you want to be disciplined. Now you can have a dynamic plan that shifts risk or equity exposure based on long-term trends in the market, but trying to go all in or all out in the market, that is not advisable. Figuring out how much risk you can truly handle is crucial to avoiding those emotional moves. And when we say the word risk, we really more so mean volatility. We're not going into some hot stock, some hot IPO stock or biotech stock. We're going into diversified baskets, or at least for those of you listening in, you probably should, with retirement assets, be going into diversified baskets. So it's just volatility, the ups and the downs that you're seeing when people say risk. Over the next 50 years, if we're forward looking, we are bound to see multiple bear markets of, say, 30 to 50%. We'll probably see another financial crisis, most likely another pandemic, and definitely more recessions. It sounds scary, right? But that should not make you emotional with respect to your portfolio or the decisions around your finances. Of course, that is easier said than done, especially if you don't have the right guidance from, let's say, a trusted advisor. But what you can do, whether you do it on your own or you're doing it with an advisor, is preparing for those worst case scenarios for your portfolio so that you can weather through any market condition that occurs. Right now, the market is back at an all-time high. We actually just hit a 2-year anniversary earlier this month from the October lows in 2022. And so a lot of people are feeling great about their portfolio if they're invested in equities. Warren Buffett, one of the greatest investors of all time, he had said a very famous quote, which is, "A rising tide lifts all boats. It's not until the tide goes out that you realize who is really swimming naked." I love that quote because it means that you need to prepare for those black swan events once they eventually happen so that you can make sure that you don't jump off of a cliff, so to speak, with your emotions, with your portfolio, potentially just selling out and never getting back in. And that can, of course, really impact long-term performance. What we see here on this chart is a stress test that we generate for our clients based on their own specific financial plan. It shows us a probability of success with certain negative assumptions that we look at. So we'll look at equity markets dropping immediately by 20% right as you retire. Let's say Social Security is reduced. Inflation is a lot higher than we expected. Let's say taxes, we'll talk about that later on, go up by about 20% from current levels. You live about 5 years longer than you anticipated, and then healthcare costs. So we look at these negative assumptions, and we want to make sure that your plan and your portfolio can withstand those potential scenarios happening. This question here is a fairly basic question, and it's one that we cover during the process of onboarding a new client. Determining how much of a temporary decline, or what we like to call drawdown, during those worst case scenarios, like the financial crisis, like the tech bubble, and looking at it not just in a percentage, but dollar terms, is a great exercise to do And it's one that we do not only when we onboard clients, but at least annually with our clients to make sure that we're on the same page with how much risk they can tolerate and their portfolio. Keep in mind, going through a risk assessment like this versus actually seeing your portfolio drop month after month after month could be very different. But that's why having those consistent conversations with you to define, okay, we just had a bear market, your portfolio went down, let's say 15%, and that's what we agreed upon as a risk tolerance, but that really got you nervous to the point where you were close to hitting that panic button. Well, then maybe we do need to make a slight change. So, to summarize, figuring out your true risk tolerance is key to help you avoid becoming emotional with your portfolio when the market does eventually drop. It's figuring out what that line in the sand is for you during those worst case scenarios so that we can keep you within your comfort zone. All right. So, moving on to risk number 4, high fees. To me, this is one of the most important factors, regardless of portfolio size. Doesn't matter if you have $200,000 or $100 million, fees can wither away at your portfolio, more specifically, mutual fund fees. We see this one quite often, unfortunately, whether that's an advisor putting their clients in high fund fee mutual funds, or you just have your 401k that's invested in mutual funds with high fund fees. The latter is becoming less of an issue, which is fantastic. But either way, those are both not great. And I'll explain why a little later on. But let's first break down how fees work for funds. The fees for mutual funds or even exchange traded funds have a technical term called the expense ratio. That's an important term to know. Believe it or not, there are still advisors out there, I probably more so refer to them as brokers, sorry, that put their clients in mutual funds or even certain products that in turn pay that advisor, again, more broker, a commission on the back end. And it's not necessarily in the best interest of the client. That to us is not considered a true fiduciary. What you can do to find out if you are paying higher fees is you can look at the expense ratio on the mutual fund or the ETF prospectus. It's called the prospectus, which also does show historical performance net of fees. You can find that online. You can do some research on your own. You can even reach out to our team. We do utilize a tool that basically does a health check of your portfolio to really show you how much you're paying total in fees. Many times, potential clients don't realize the funds that they're invested in even have fees or are even underperforming, which we'll talk about in a moment. But why is that? Why don't people realize that they're paying fund fees? The reason being is that the funds that they're invested in don't actually pull the funds from your account like you would see, let's say, an advisor fee or a transaction fee, similar to how you would see things on, let's say, a general ledger. It has an itemized breakdown. You don't see that with the expense ratio. What happens is the funds are repriced, which in turn take into effect the fees that you're indirectly paying. So instead of seeing the fees, you're just having that fund repriced net of those fees. So you may be thinking, well, why are fees so important? As you can see on this chart here, we're going to look at a $100,000 starting value with a 6% compounded rate of return each year over a 20-year time frame. The higher the fees, the lower the ending value, as you can see here. Let's first start with a 2% fund fee or expense ratio versus 1.5. As you can see here, the difference over 20 years is not too substantial, but as you go further and further up that ladder to lower fees, you can see that there's actually about, call it $100,000 difference between the 2% expense ratio and no annual fees whatsoever. And that's just with $100,000 portfolio. Now imagine if you had one, two, three, $4 million. That makes a big impact. And that is why we think fees are so important, especially if there is no value add, or let's say you're doing it on your own, outperformance with the funds that you're invested in. Some of you may be thinking, well, why pay an advisor? Why pay them an advisory fee? Well, if the advisor is truly adding value within the portfolio with ongoing management, diversifying you with different investment strategies, coaching during those bear markets, tax planning, estate and legacy planning, insurance planning, then the fee is definitely justified. The value that you're going to be receiving from that type of scenario will far exceed the fee that you're paying. However, if your advisor never calls you, they're not being proactive with tax planning or the other features that we had just mentioned, they're underperforming consistently, and in turn, they charge you a high fee and put you in high mutual funds, then it's probably time to start looking elsewhere or parting ways. Now, one last thing I'll say with respect to fees is, given we're a registered investment advisor, we're not part of a broker dealer, we can be very fee conscious for our clients on the advisory fee that we charge, because the only people that are paying us are our clients. And that in turn is what makes, in our opinion, a true fiduciary advisor. So looking at lowering fund fees, according to Visual Capitalist, if you look over the past 20 years, 95% of actively managed large cap mutual funds have underperformed their benchmark. I'll say that again. 95% of actively managed mutual funds have underperformed their benchmark. Put differently, to sound a bit redundant here, but to say it a little different, out of 100 funds, 95 of them underperformed. So instead of trying to find the needle in a haystack with mutual funds, as this chart shows, owning an index fund or an ETF with little to no fees may make the most sense for you long term. Like we saw from the previous chart with funds at roughly 2%, that can make a massive impact long term. So for our clients here at the Clark Group, we really do like low cost funds. Some of our funds have little to no fees factored in. And we go into asset class pairings like the NASDAQ, or even the S&P 500, or even in value-oriented fund, or even sector-focused ETFs that are low cost and have historically proven to provide better risk-adjusted returns than the benchmark, and again, at a lower price point. Of course, gotta say it, past performance is no guarantee of future results. What can you do to make sure you're not overpaying for underperformance? Take a look at the funds that you're invested in and track the fund's performance net of fees. So if you have a 401k, some 401k custodians don't make it easy for you to look at. Reach out to our team and we can help you with that process, and we can generate that health check or that portfolio analysis for you to show you how much you're really paying in fees. All right, shifting gears outside of your portfolio, even though I would say they do interplay with one another, is risk number 5, taxes. As we know, death and taxes are the only thing that we can't avoid. We all know that, pretty bleak. But if we take a step back and we look at where taxes are headed, our national debt is above $35 trillion, and it's aggressively growing as time goes on. In addition, our Social Security Trust Fund is set to be depleted by 2033. This is for a different discussion. I don't think that will happen. But the reason why, or one of the reasons why I don't think that will happen, is because the government will step in, probably towards the bottom of the 9th inning, and then raise taxes. I was actually watching Avengers, the movie, recently, and the main villain said, Thanos, I believe his name is, he said, as he was destroying the whole population, he said, I'm not evil, I'm just inevitable. And I think that applies to taxes, whether you like them, you're indifferent about them, they're inevitable. And the likelihood that the tax rates will go up seem pretty high. So what should you be doing? You should be having conversations or thinking about your taxes, either with a tax advisor or with your financial advisor, about how tax rates might impact you moving forward. So the current tax code that we have, called the Tax Cuts and Jobs Act, that was implemented by Trump back in 2017, and it went into effect in 2018. And it's one of the lowest tax rates we've ever seen in the history of taxes. Now, come 2025, if Congress does not step in, to Congress and the president step in to extend the tax code, we will revert back to prior levels, meaning higher taxes. So at the very least, we need to be planning or having discussions around how that might impact you. Before we discuss one option that you could utilize, let's look at the current tax rate, which is TCJA, current tax code for short, versus what they will revert back to. You can see, well, let me take a step back. Let's explain what the progressive tax code or the current tax code is. It means that the more that you earn, the more dollars that you earn, the higher the tax is on those earned dollars. The worst kind of tax rate is ordinary income tax, what you see here. Typically, the best is long-term capital gains tax because it's somewhere between 0 to 20%. So like we discussed, these tax rates, they will most likely revert back. What can you be doing to think ahead with respect to tax rates going higher? Now, one other thing too, going back to this chart, one other thing that's important is that once you reach a certain age, known as your required minimum distribution age, which is either 73 or 75 based on your birth year, you're required to take out a mandatory distribution from your retirement account. So think your 401k or your IRA. That in turn can jump you up into a higher tax bracket, meaning you're going to pay more in taxes. Also, something that's not talked enough about is Medicare premiums. What you pay in Medicare premiums is impacted by your taxable income. The more you earn, the more you have to pay in premiums. So if we look at that RMD and you're forced to take out money from your retirement accounts, that right there could bump you into a higher bracket and in turn make you pay more in Medicare premiums, also called IRMA. So what can you do to lower taxes? This is potentially just one strategy. There are other options out there like tax loss harvesting, capital gain harvesting. There's depreciation, cost segregation. That'll be for another time. One thing you can do specifically with your retirement accounts is converting your traditional IRA into a Roth IRA. Let's take a step back and let's talk about what is a Roth IRA. Anytime you hear the word Roth, think 100% tax-free. To me, that's the best type of account that you can have because, of course, it's tax-free. The money that you put into a Roth, whether it be a Roth IRA or a Roth 401k, you're paying the taxes up front on that contribution. And now all the contributions and earnings 100% tax-free upon qualified distributions. With a traditional IRA or 401k, the money that you put into those accounts, you're able to deduct those contributions from your income for the year, meaning you're lowering your taxable income. You're getting an immediate benefit. But moving forward, it's tax deferred. So once you take distributions out of that account, you have to pay income tax, which again is the worst type of tax out there on those distributions. One thing you can do though is you can convert a portion of your IRA or 401k into a Roth. And now that money grows tax-free, but whatever amount you convert, you have to pay taxes on it. Some of you may be thinking, well, why would you do that? Well, we're in a historically low tax rate environment, given taxes will potentially go higher, so it could be a good time to do so. One other thing you have to keep in mind though is you don't want to just jump in doing a conversion because you're now going to have a tax-free bucket working on your side. You want to get very strategic about your specific situation and how it applies. We see clients that might have a 1, 2, 3, 4, 5 year period, call it, where they're not collecting their pension. If you have one, they're not collecting Social Security, but they're retired. So they're going to be in a slightly lower tax bracket or be paying or earning less taxable income. And that could be a great time to consider converting some of your IRA funds into a Roth IRA. If you do that, similar to the RMD that we had discussed, once you reach that age, you're then required to take money out. And at that point, it might be a little too late to convert. So how can you convert? Well, there are two different ways of doing it. First option is you're just doing a lump sum conversion. So for example, if you have $1 million, you're converting $1 million into a Roth, probably would not want to convert the full amount. I would suggest option two, incrementally doing the conversion. Let's say over a 2, 3, 4 year time frame is usually the best option. Now, there are a couple things to consider. One is the 5 year rule, whereby if you convert money into a Roth IRA and you haven't had a Roth open before, in order for the earnings, the growth to be 100% tax free, you have to wait 5 years before you can touch that bucket. But the contributions, whatever amount you converted from the IRA to the Roth, that is 100% tax free. The other thing to keep in mind is if you're under the age of 59 and a half and you decide you want to convert your pre-tax dollars into a Roth, you'll want to do so with outside cash, because in the eyes of the IRS, if you're doing a conversion and you withhold taxes on that conversion, the IRS looks at it as a distribution. So you would then be hit with the 10% tax penalty. So you obviously wouldn't want that. You would just use outside funds, outside cash, most likely in a savings account or a brokerage account to pay for that conversion tax liability. What about if you're above the age of 59 and a half? Well, in that case, you can, of course, pay the tax consequence with outside cash, or to avoid yourself the hassle of a hefty tax bill or potentially quarterly tax payments in retirement, you could actually withhold taxes on the conversion. And it's just as simple as stating what you want on the federal and state level if that applies to you. And this is something that we do help our clients with all the time. All right. So we'll go through risk number 6 and risk number 7 fairly quickly, given the time. We're getting a little close on time here, but looking at risk number 6, long-term care expenses. This is a tricky one, and it's gotten tricky as time has progressed. About 15, 20 years ago, as long as the premiums made sense, it was usually very advisable to get a long-term care insurance policy. However, these insurance policies, just like any type of insurance out there, is getting more and more expensive, and at times even unattainable, regardless of your health history. So what people are doing is they're looking more towards self-funding, putting aside and planning for funds for those potential long-term care expenses. At the very least, though, it's good to be aware of long-term care insurance, which we'll talk about here in a moment. Before we do that, let's take a step back at long-term care and what that could look like. So the world's population is aging at a faster rate than ever before, and people are living longer. Hopefully they're living healthier lives, but a big reason why people are living longer in the first place is because of the advancements in healthcare due to technology. Every day up until 2030, about 10,000 baby boomers will turn 65, and 7 out of 10 of those baby boomers will require long-term care at some point in their lifetime. Some of you may be thinking, well, what about Medicare? Medicare only covers the first 100 days in a skilled nursing facility. It's not intended for long-term care, more specifically long-term care at, let's say, your home. As you can see on this chart for the state of California, where we're located, the average cost of a private room in a nursing home in this state is about $146,000 per year. To put that into context, let's say you have $1 million portfolio while you're in retirement, and you get to the point where you don't have insurance for long-term care and you need to pay that out of pocket. Well, that's a 14% withdrawal rate per year for long-term care expenses, and that can really aggressively drain your nest egg if the proper planning doesn't take place. Let me ask you this question. I love to ask this during presentations because I usually get kind of a mixed answer, but how many of you believe or know that, excuse me, how many of you know of somebody that you think will receive long-term care at some point in their life? Probably all of you know somebody that will need that care. How many of you think it will actually happen to you? Some of you may say yes, that I think it'll happen to myself, but a lot of you don't really think, or at least we've seen, not a lot of people think that something like long-term care could happen to them, even if their health history is pretty clean and positive. As we see on this chart, about 70% of people over the age of 65 will need some form of long-term care in their lifetime. Again, at the very least, what we suggest doing is having a discussion around long-term care, whether that be self-funding or you get insurance for long-term care. So what are some of the considerations for getting long-term care insurance? It's protecting your assets. Let's say you have loved ones that you want to pass on your assets to. You don't want to aggressively tap into your wealth to pay for those long-term care needs. Well, insurance stepping in could help offset a majority, if not all of those long-term care costs. Potentially high-end care too, instead of just going into a facility where you have 3 other people crammed into your room, private room, people that you want to work with that are taking care of you, a more high-end premium service. Usually insurance will help with that coverage. And then end-of-life care, again, more along the lines of peace of mind, making sure that if that time comes, you have the proper setup in place. As I mentioned, getting insurance is starting to get more and more difficult, but we suggest at least speaking to a long-term care specialist about your specific situation. And they can tell you whether they're able to get you a policy, whether it seems affordable, and you don't even have to pay that specialist until you find a policy that makes the most sense for you. Our firm has specialists that we refer our clients out to. So if you are interested in having that conversation, please feel free to reach out to me and we can have that discussion. The topic of death is a blast. I'm sure you're enjoying hearing this, which will be my final point: estate planning. Without the proper planning in place for estate planning, you could leave a real mess behind for your heirs, potentially children or other loved ones. Probate, which we'll discuss briefly later on, is one main reason why people would create an estate plan, more specifically a living trust. You typically want to list your real property, your home, in the name of the trust to avoid probate. So you would literally change the title of your home into the name of the trust so that once you pass, based on how your trust is written, your home can go directly to those beneficiaries that you want inheriting the home. Now, most people, when they think of estate planning, they instantly think, oh, well, you're just thinking of death. You're planning for your death. That's not the only factor that's involved in this process. So there are other important documents within an estate plan, which are your power of attorney, a medical directive, and then a will. Starting with power of attorney, this is usually a trusted person that can step in. Let's say you become incapacitated or you can't handle your finances, and this trusted person can help make those decisions for you. It gets very tricky if you become incapacitated and then you try to set up a power of attorney. It'll cost you a lot more in attorney fees and potentially become more of a sticky situation. So setting up and having a discussion with somebody you trust, getting that legal document of a financial power of attorney in place ahead of time will make sure that your finances will be well taken care of should you become incapacitated. The other document is a medical directive. Again, this is a trusted person that will make decisions on your behalf in regards to your health. So you want to have that discussion with that person. Let's say you get in a car crash, you get to a point where you could become paralyzed. Is that the type of lifestyle that you want to live? Potentially, you want to plan for those scenarios and make sure that the medical directive that you set up, that person is aware of what your wishes are. Lastly, a will. This is a legal document that coordinates the distributions of your assets after you pass. It's crucial to have because it allows you to communicate your wishes clearly and precisely to how you desire. Now, there is one last document that's important, and I alluded to it earlier. It is a living trust. Fortunately for retirement accounts or bank accounts or even investment non-IRA or non-401k accounts, you can list beneficiaries. So once you pass, those assets can go directly to those beneficiaries. You do not have to go through the probate process. However, with real estate, like we discussed, if you don't have a living trust set up in the title of your home, then in most states, you will have to go through the probate process in order for, or rather, your heirs will have to go through the probate process to inherit and get title of that home. Some states, the probate process is a breeze. Washington, for example, the attorney that our firm works with to one of the many attorneys that our firm works with to refer clients to for their estate planning needs. They're also licensed in the state of Washington. That's a state where the probate process could just be a few weeks and the beneficiaries will get the assets very efficiently. In a state like California, that is not the case, believe it or not. It could take years and an egregious amount of attorney fees out of your estate just to have your loved ones take ownership of that asset. So at the very least, talk to our firm if you think it might make sense, if you're not an existing client already and we haven't had that discussion, talk to our firm about whether an estate plan might make sense for you. But quite frankly, it all comes back to your overall financial plan, covering each bucket of your financial situation to make sure that we've checked off the planning process with setting up things the right way for you and your loved ones. All right, so we have covered a lot today, and we went over what we believe are 7 crucial risks to your retirement. So where do you go from here? Reach out to our team to see if we're able to help you properly plan for retirement if you're not an existing client. We can help you avoid these costly risks. What you can do to get in contact with our firm if you're not an existing client is if you go to our website, which is just clarkgroupam.com, top right-hand corner, you'll see a big yellow button that says schedule a call, and you can book a free discovery call with our team. So hopefully you found the topics discussed helpful to you, and we do really appreciate you tuning in today. Thank you.